My point with the 1940s is not that we're going through an identical period, but that it's the closest period that we should be familiar with. If we're basically things that seem shocking are less shocking in financial markets to you if you are familiar with the 1940s. You're like, oh, it's kind of like what happened there. And so it's basically the closest template we have. And then the question becomes, how do we differ from that template? What are the differences? Because it's not identical. And one example is that back then the United States was running structural trade surpluses. And the UK, the existing power at the time, was the one running structural trade deficits. And so now, in many ways, the United States more resembles the UK from the 1940s, where they're the leading power, and they have the structural trade deficit against a rising power, which back then was the United States, and now is China. And that doesn't mean it's going to follow the same exact pattern. There's obviously different geographic differences. There's all sorts of differences there, but there is kind of a semblance there. And generally, what I was seeing was I wasn't talking about kinetic war, but I was talking about essentially wartime finance, where back then you had very large fiscal expenditures that were monetized, and it was very inflationary, and it was very commodity heavy. And what we were seeing in response to a pandemic hitting a highly leveraged system, right? Because humanity's had pandemics in the past, and if you don't have a lot of leverage, it's not that it's obviously still bad from a humanitarian standpoint, but from a financial standpoint, it's not the end of the world. But if the whole system's so tightly geared and there's so much operational leverage and financial leverage that it can't absorb shocks, right? It could be anything. It could be a natural disaster. It could be a virus. It could be a war. If something hits a system that levered, you get these. Basically the system cannot let itself collapse. Credit markets are based on always expanding, and that's why these kind of recessions have gotten kind of shorter and crazier with bigger and bigger government responses. And so when you're kind of at the long-term debt cycle, you're already at the zero bound in terms of monetary policy, and you get a big shock to the system, you get a massive fiscal response. And so it looked like wartime finance, even though we weren't in a kinetic war with another country. We were at war with, biology, essentially. We were at war with just saving our leveraged system. And I was hoping that it wouldn't turn into an actual kinetic war, but the other thing I was looking at was, so I'm quantitative. I focus more on the quantitative side, but I also pay attention to the qualitative side. So, for example, there's a book called The Fourth Turning, where they look at cycles from a demographic standpoint. It's his two historian demographers wrote that, and there's some aspects that seem, you could say it's wishy-washy, but it becomes more interesting when you say that. So their argument is that every roughly 80 years, you have kind of a generational crisis where prior institutions get torn down, new institutions get built, the social contract gets destroyed and renewed, and it could be good or bad. I mean, you could replace a decent social contract with a worse social contract, or you could build something better. And what I noticed was that all of his, quote unquote, fourth turnings, his crisis standpoints, coincide with long-term debt cycles, right? So basically, in all those long-term debt cycles where you get kind of a big shift in monetary policy, you also have rising populism and things like that. And so it's not surprising that you get wars in those periods. And basically, those wars are kind of the catalyst. And, I was hoping that this period would be one without a kinetic war, and that it would be purely kind of, humans versus nature, or humans versus their own leverage, essentially. But now, we're throwing kinetic war into the mix. And so it's unfortunately even closer to the 1940s. And now I would say hopefully the war doesn't get anywhere near the scale as it was in the 1940s, but you do have you have protectionism, you have increasing geopolitical contact after a period of relative harmony, and you have a highly leveraged system. So in many ways, it just continues to resemble the 40s, closer than I could have imagined. So my base case throughout the 2020s is that we'll have higher than average inflation compared to the 2010s. Driven by just commodity supply limitations, large fiscal spending, that 1-2 punch. And then generally when you have new technologies and sovereign debt crises, that's when you get shifts in the monetary system, right? So the prior shift was the 70s, the one before that was the 30s and 40s. And so I do think that we're on the verge of kind of another monetary transition. To your point, one of the arguments I made is that, this period is pretty unusual, where we have like one fiat currency at the heart of the whole system. People assume you have to have what is the world reserve currency going to be? And it's like, well, this was the anomaly, I would say. That basically after World War II, the United States was like 40% of global GDP. Right now it's down to 20% of global GDP. There's no country big enough to be the world reserve currency alone. and nor do they want to. Nor is there enough geopolitical consensus and power concentration to have a hyperpower that can just dictate terms, right? So I think we're heading in a more multipolar world, which includes a multi-reserve currency world. So you can look at, say, the SDR basket. That's 5 major currencies. They're kind of the reserve currencies, and the United States dollar dominates it. But I think over time it spreads out a little bit. We've already seen that mildly for 20 years. So the US dollar share of global reserves hit a peak about the year 2000, and it's been in a kind of a sideways to mildly down trend. And I think that continues, could accelerate. And I also think there's going to be an increase. There's, ever since around 2014, there's been an increasing shift towards neutral reserve assets, which currently means gold, meaning that if you look at official central bank holdings of treasuries and gold, both have gone up in dollar terms, but gold, they've been buying gold and their gold's been appreciating. And we see, for example, with this recent event that, treasuries were considered risk-free assets. But now we see that if you are a country that is belligerent, or a country that is, for whatever reason, not on good terms with the US or Europe, and that can take a variety of forms, right? So right now we're saying, okay, if you do something extreme like war, your reserves could be frozen. But in the future, you have to say, okay, what would future politicians do with reserves, right? Could we freeze the reserves based on trade disputes? Could we freeze them based on commodity disputes in a truly scarce world of commodities? And so countries are saying, okay, well, so if my reserves can be frozen, they're not risk-free, and they're already yielding below the inflation rate, as we just discussed. They're being financially oppressed. They're just melting ice cubes. So what other assets can I put reserves into? So one option is you could go into a couple different currencies. So Russia, for example, had their dollars and euros frozen, but their yuan and their gold is still fine, right? So you can do that. And then 2, you can get into gold. And gold is really the only commodity market big enough to be like a long-term store of value. It's not really big enough. It's, if you do the math on what it would take for China to go to an official, and now some estimates think that China has more gold than they say, but let's just take them at their face value. And they say, okay, they want to get up to a 20% weighting of gold reserves as a percentage of total FX reserves, like Russia has. What would it take? Well, the gold market's not really big enough to absorb that flow without a big price increase. And that's just China. What if every country wants to go, in whatever allocation they have to gold, they want to increase it by 20%? This is not a big enough market. And then you can look at things like Bitcoin, and you say, okay, there's a neutral reserve asset. There's a payment channel that's relatively permissionless. That obviously has interesting geopolitical locations as a kind of a reserve asset, but it's a less than $1 trillion asset right now. It's not big enough to absorb that.
A research topic I've been focusing on for a couple of years now is the petrodollar system, the downsides of it, and the eventual trend towards decentralization of that, or bifurcation of that, kind of a more multi-reserve, multipolar system. And this sort of war can accelerate that trend. And so that's how I'm interpreting it at this time. For the commodity part, that's always been a key aspect of war. During World War II, secure over oil fields was a key part of it. That's why there were a significant amount of battles, even in the European theater outside of Europe. A lot of it was to secure certain energy supplies. And so that's not new. It is relatively new to have this level of financial warfare, right? So for example, freezing reserves. And this kind of begs the question of how much Putin anticipated, because they did, make themselves sanction resistant by focusing on gold and de-dollarizing as much as possible. But they did have a very big focus on euro-denominated assets. And maybe he didn't expect that they would freeze the euro-denominated assets. It's hard to say for sure, but essentially several $100 billion of Russian reserves have been frozen by the West, by these sanctions, and that is equal to several years worth of military spending for Russia. It's a huge percentage of their GDP, a huge multiple of their annual military spend. And so it's already been an extraordinarily expensive war for Russia to fight, let alone the devaluation of the ruble, the decimation of Russian savings, the stock, their stock market being imploded. Then there's also just the reserves themselves being frozen. And that kind of shows this level of financial warfare that's happening. And, their counterpoint is, hey, we control like a significant minority of commodities, both for energy and also even for green tech. Nickel, for example, is absolutely key for battery technologies as we currently know it. And so it's kind of this war between what's going to happen first. Is Russia's financial crisis going to kick in faster than Europe and the rest of the world's commodity crisis? And we're kind of in this race between who can harm each other the fastest, while they're not having a kinetic war between each other. The kinetic war is focused in Ukraine, but these greater powers are focusing on this financial and commodity war in the background of the actual physical warfare. So I think they're both unfortunately being very successful in terms of hurting the populations. I mean, Europe's struggling with the energy crisis. Russians are struggling with the financial crisis. From my reading of it, I think Russia is being hit harder, faster. But it remains to be seen if that will be the case longer term. To the extent that sanctions help, I mean, it's challenging because polls generally showed, including Western polls, showed that actually a decent number of Russians were in favor of this type of conflict. And that could diminish over time because of this, right? Putin could lose political support, both of oligarchs and of the population. But it's unclear if that'll work or not. It could have the opposite effect. It could kind of polarize them around Russia and away from the rest of the world. I don't really have the expertise to determine how successful those will be. It's just an observation about what's happening, and so. It's not even just the sanctions, it's like all these self-sanctions as well. So a lot of companies are just saying, we're not going to sell our products into Russia. And that includes a lot of the internet companies, the the technology providers, things like that. And so in addition to bifurcated supply chains, bifurcated commodity markets, that could contribute to the bifurcation of the internet, kind of like how China and the Western world kind of have their own internets. Russia could shift more towards the Chinese internet side. And so you almost have two internets around the world. Well, one is that their savings have been just severely hurt. The Russian stock market's been closed and totally impaired. It's just completely devastated. And from studies I've seen, by example, I think Meb Faber of Cambria Investments cited this, that Russians have like 90, among the Russians that have stocks, which is not all of them, and whatever percentage they have in stocks, 95% of that is in Russian stocks, right? So they have very little global diversification, and Russian stocks were decimated. So a lot of people just had their real estate damaged. Their savings damaged. Then they had their stocks crushed, and then real estate remains kind of an open question, right? So that gets marked to market a lot slower. It's obviously a decent inflation hedge overall, but only if people want to buy those properties. If people try to, if people leave Russia where they can, that's obviously very detrimental to their real estate values. And so pretty much across the board, among multiple asset classes, they're being hurt very poorly. Now, the ones that are doing better are maybe the select few that do have a decent amount of international exposure to other assets. Could be dollars, could be U.S. stocks, could be gold, could be Bitcoin, right? So Russians that do have those foreign assets are the ones that are holding up way better than their peers. And then we've also seen in Ukraine, for example, ATMs running out of cash, people trying to flee with money that they can get. And both Ukraine and Russia are pretty high on the crypto adoption index that the Chain Analysis kind of puts together. So I believe Ukraine was number 4, Russia is something like number 19, and so both of those populations do have rather high amounts of Bitcoin and crypto exposure. I don't know specifically the breakdown because I think the crypto index just kind of looks at multiple assets, but obviously it's generally Bitcoin focused, and so both of them do have a decent percentage of people that have those assets, and those that had them are more protected. See, oil is more fungible, right? Because except for very niche situations where kind of a region's cut off from supply chains, for the most part, there's less extreme oil pricing differentials around the world because a barrel of oil can be transported relatively easily. And so you get minor differences of pricing, but not usually huge differences in pricing. Whereas natural gas, because it's harder to transport, naturally has bigger price differentials between locations. But even before the war, we were seeing this between, say, Europe and America, where Europe, at some points had gas that was like 10 times more expensive than America. And that's because you either do pipelines, which is obviously very location specific, or you do LNG, which is rather expensive and has very limited capacity, right? So we can't just like triple our LNG next month, right? So there's hard limits on how much you can do, and so that infrastructure takes time to build as well. And so it's a mess on both sides, and it's one of those things where almost nobody wins from this conflict, it seems. Well, at least on the commodity interests. I think over time, Russia will probably be able to access a number of markets that they don't really have the ability to select where they get their commodities from. So maybe we can look at, countries like India, countries like Brazil. We'll see over time, the longer this drags out. I think Russia will probably be able to find buyers for its commodities. But during this period where they need capital, and many of their assets are selling very cheaply, that does give China a window to come in and get a lot of those assets. Well, the economies, so partly what we're seeing is that Russia is seizing some of their, their shipping assets and things like that. And so part of why wheat, for example, is so expensive is, one is that Russia is a big wheat exporter, but so is Ukraine. And so to the extent that Russia is able to control large portions of Ukraine, I think what we're seeing is that, we're kind of missing a harvest season. We're missing a planting season over there. And so that's going to affect global wheat prices and global just, agricultural in general. And then, obviously it's hard to function even in an inflationary economy, let alone a war economy. It's very hard to have a functioning economy. You have well over 1 million refugees spreading into the rest of Europe. And so it is hard to call that a functioning economy at this current time. And so that's obviously impacting a lot of that region, but then specifically it contributes to the commodity shortfalls that we see worldwide.